What is an expense and what is a capital asset? When you spend $100, is it an asset or an expense? The accounting treatment is very different between an asset and an expense. Assume you have an airplane and you are changing the oil on the engine. That happens periodically. It's normal to change the oil. And it is maintenance. Each time we have a maintenance in a company, income goes down, we do the mustache, and the CFO is down because we paid the cash, and equity is lower because we are poorer. Now, on the other hand, suppose you spent $100 on changing the engine of the plane. Now the plane is better, stronger, lasts longer, and the plane is more valuable. This type of $100 of cash spent qualifies as an asset. As you see, we are not poorer like in the maintenance example above. Here, actually, the $100 spent results into an asset. Makes sense. We spent 100, but actually got something tangible for it. Now, how does all this get manipulated? Well, we know that expenses makes us poorer and assets makes us look better. Great. So, CEOs have the incentive to make companies look better. Perhaps some things that should be classified as maintenance get pushed into getting classified as an asset. Have I seen this happen in my life? Many, many, many times. No one wants to show an expense. Imagine you are changing the oil on a plane. That is maintenance. Maybe you change a spark plug. That is maintenance also. How about you change a cylinder in the engine? Is that maintenance? Perhaps you changed 4 cylinders. At some point, a CEO will have to say, this is no more maintenance, but it is an asset. There is no black and white in accounting. Everything is subject to an opinion and an interpretation. In accounting, there is a lot of flexibility, and it is more gray than black or white. If I was to be honest with you, I would say that accounting is at least 50 shades of gray. And in my lifetime, I have seen all of it and more. How do we account for assets? Mostly historic costs. You buy a building for 20 million, and if the building today is worth 50 million, you still keep it on your books for 20 million. Accountants are a conservative bunch. They do not like fair values and market values. They like traditional values, historic costs. You bought the building for 20 million, then keep its value at 20 million. Did the value go up? That doesn't matter. Values going up do not benefit you, unless you want to sell the building. You want value? Just sell. So accounting is mainly done on an historic cost basis. In the US, companies are not allowed to adjust the values of buildings upwards. They have had a bad experience with this since the Great Depression of the 1920s, when asset values were inflated by managers. In Europe and IFRS, we allow using fair values and market values to adjust the values of assets. But few companies do this. It is simply not practical. Imagine Siemens, the large German conglomerate, having to evaluate and readjust the values of all its PP&E and land all over the world every single year. This is not practical. Siemens would need 1 million accountants for that, and even more auditors to check the accountants' work. Using fair values, even if allowed, is not practical in the majority of the cases. Market values and fair values, apart from being impractical, are also subject to manipulation. Imagine companies had the right to decide what the value of an asset is. Everyone would say that their assets are worth zillions. We would get independent experts, and we would choose the independent expert that agrees with our valuation. Many years ago, I was approached by a company asking me to give an opinion about their accounting treatment. All I had to do was to sign on a report they had prepared and to agree with them. I was valuable for them. I was an independent, honest university professor in one of the best universities in the world. The sad thing about all this is that if I did not agree with them, someone else would. And if someone else would not agree, they would find somebody, somewhere else, somebody who would sign. Apple has a lot of assets, about 40 billion. 20 billion of it is in land, 78 billion is in property, plant, and equipment, 11 billion in leases. Total tangible assets are 109 billion. Accumulated depreciation is about 70 billion. Their net asset position is $39.4 billion. They write in their notes in the 10K that they depreciate assets on a straight line basis. 40 years for buildings, 1 to 5 years for machinery and equipment. Some software they have manufactured, which qualifies for being treated as an asset, and US GAAP provides some exceptions to software, is amortized over a 5 to 7 year period. Reading the notes helps us understand how PP&E is depreciated and how intangible assets are amortized, although many companies are vague in their accounting disclosures. And it is often hard to get the level of detail that you might want to see. So in the case of Apple, if you want to know what is depreciation and what is amortization separately, that information is not given. They say depreciation and amortization is a total of 9.5 billion, but to know the component of each of these two items, it is impossible to know. 150 pages of a 10K, and you really do not get to know some of the simplest answers sometimes. On the other hand, Facebook has a pretty good disclosures on its tangible and intangible assets. If you look at their notes in the 10K, you can see that they have $5.38 billion of gross intangible assets, with an accumulated amortization of 4.7 billion. This gives them net intangible assets of 634 million. They further break this down into various categories. Acquired users have a gross value of about 2 billion, and acquired technology has a value of 1.4 billion. Patents are 800 million, and brand names are 644 million. But why does Facebook have so many intangible assets? And how and where did they acquire them? The answer comes in their prior acquisition of WhatsApp and Instagram. These companies were startups when they were acquired. Facebook paid about $1 billion for Instagram and 18 billion for WhatsApp. When they purchased these companies, they acquired a lot of intangible assets that they had to account for separately. So when you buy a company, you need to get their assets, whether tangible or intangible, and list them on your own balance sheet.